today. I call it Market Geometry, and it's Market Geometry 2, which means it's the second part of a series that we're doing. Now, I know the screen says Market Geometry 1, and what we're going to do is we're going to scroll through what we looked at last week, and then we're going to refresh ourselves and then come up to this week's information. What I did for this week was really focus on just several slides, not many slides, but real good quality on what we should be looking at in terms of Elliott wave and how to start looking at price structure. At the end of the slide, I gave you one example of what time ratios would look like, but I know those of you that had asked me during the course of the week, are we going to be speaking about time, which there's horizontal and vertical Fibonacci. There's price and time. So we're going to end it looking at time, and then the next week we're going to go into time ratios, and then we're going to go into the harmonic patterns, and we got a lot of good things to talk about. But I want to bring it 1 week at a time, one step at a time, so that way we're all on the same page and we're looking at the same thing, and you guys are getting the proper education step by step. There's a saying, how do you eat an elephant? It's one bite at a time. So I don't want to jam everything down your throat in one day. So we'll do it over a period of several weeks. And I think you're going to really like how everything starts to come together. And you'll just see that market geometry really is a phenomenal way to approach the markets. And then later on in the future, after that, we'll start looking at indicators and oscillators and the MACDs and the stochastics and all that other good stuff. But for now, more or less, I want to just focus on the market geometry. So let's take a ride through what we looked at last week. And last week we discussed trend, range, price relationships, and started talking about Elliott wave. Now, this information is also in your back office of your website under the trading series, educational trading series. All right, so we have that already put up there in the back office, and we'll just continue to add videos for you along this topic under the market geometry. And last week we discussed what a trend is, and what we're going to discuss today has direct relationship of what we discussed last week. Trend, an uptrend series of higher highs and higher lows, and a series of a downtrend is a series of lower lows and lower highs, and we see this evidence right here. That's what an uptrend looks like, and that's what a downtrend looks like. And remember, you can go back to the prior videos that we recorded, and you could always go through them and advance forward to get your education proper. And we discussed what a downtrend was. We discussed what an uptrend was. And basically, the uptrend is higher highs and higher lows at every high. Well, if I can get this, every high is higher than the prior high, and every low is prior than the higher low. And that is what an uptrend is, or a trending market. Next. Okay, we discussed what a range is. A range basically is where the market is going sideways in a zigzag action. And basically what is actually, if you were in the live training room today, you would have seen what a range is. And I do promote being in the live training room during the course of the day. You get a lot of education. There's not a lot of educating all day long, but we look at different points throughout the day and we educate on what is happening. And today we actually are in a trading range. Today was a range that looked just like this, or actually what you see on your screen right there. So we taught about this, we spoke about it last week, and we discussed staying out of a trading range because it becomes more trouble than not. You can get into trouble, and we don't want you to do that. Then we discussed price relationships, A to B, C to D. What is an A to B, C to D? Basically, you could see right here the A to B, C to D relationship. And this is going to hold true for what stuff we're doing today. Let me see. Oh, look at that. Many times you'll see the A to B and the C to D have an equal type of swing. So when the market goes 10 points here and retraces 10 points, a lot of times you'll find a support type of area. And that's exactly what that is. Now, in a trending market, you'll see many times you'll have these same type of little relationships, and those little A to B, C to D relationships that we look at. And in a downtrend, the same thing holds true. Is you have your A to B, C to D. In a trending market, we tend to look at this, and this works out to be more of an Elliott, and you're going to learn today what a 0, a 1, a 2, a 3, a 4, and a 5 is, and that when we talk about the 1 to 2, 3 to 4, I want you to keep in mind the A to B, C to D, and we're going to discuss that a little bit more in detail as we approach each slide going forward. So keep that in mind. In a trending market, these A to B, C to D relationships are also tied into those 1, 2, 3, 4 and the Elliott wave process. And here's another example. This example, even in the Elliott wave theory, you have your fifth wave up, and then you have your A, B, C corrective wave. Also, this can be considered an A to B, C to D relationship, but when you're looking at Elliott wave, where you have 1, 2, 3, 4, 5, and you zero down here, you'll have your ABC corrective wave, and you're going to learn that today of what that looks like. Now, last week we ended with this slide, and this slide was basically giving you the beginning of Elliott wave and the thought behind it and the structure behind it. Now, typically in an Elliott wave process, you have a 5 wave. 1, 2, 3, 4, 5. When you have that corrective wave process right here, this actually also turns into that harmonic wave, where you'll have what we call an X, A, B, C, D, and it looks something like that. What we call maybe a Gartley or a butterfly or a bat or a crab pattern, which we're going to discuss next week. But we can't discuss this until we discuss Elliott, and we discuss the trend, and we understand the foundations that go behind these patterns. And today we're going to discuss market geometry, and this is the second in a multiple part series discussing this. Now, I've been doing market geometry for many years, since I guess the late 90s, 97, 98. I started approaching and learning it, and I've had many mentors along the way, and I've read many books on sacred geometry and divine geometry, and all sorts of everything that revolves around what we call phi or phi, depending on how you want to say it, PHI, okay? And it all revolves basically around the 1618, which is the perfect number. I'm not going to get too deep into that, or the 618. And this is small PHI. So you have the big one, phi, and the smaller one. And the big one is 1618, and the little one is 618. And this is where everything is revolved around when it comes down to Fibonacci and market geometry and relationships and squares and rectangles. And you can go anywhere in the world, look at plant life, look at the human body. You can look at architecture around the globe from thousands of years ago. You can look at the pyramids. You could look at the stars and the sun and the earth, and however you want to do it, it always seems to revolve around the world's perfect numbers. So even that spiral, that nautilus shell, or just natural spirals, they have their 618 and 1618 relationships, the solar system. So it all comes down to these numbers, but we're not going to get too deep into that. If you want to learn more about that, I did a nice class. It's in your back office under the trading series. It's called Commonalities. It's a commonality video, and it breaks down all these numbers squares and rectangles and shapes, and it gets more into the relationships and commonalities. And you're going to take what you've learned today, what you learned last week, and you can actually look at what we did in that prior video. It was a couple of months ago, and you can see how everything just ties together real smooth. So I'm not going to keep it, here it goes. I'm not going to keep it confusing today. I'm going to keep it simple so that way we go step by step. So the next thing we're going to talk about is basic retracements in the market and what they call, and we'll put quotes around it, Fibonacci. Now, Fibonacci, we have 38.2, a 50%, and a 618, which is the ones we're just going to focus on right now. All the other complex ones we're not going to worry about. There's all these other ones, and there's many different projections and extensions we're not going to get into. This right here, the 70.7, that has to do with the square and the diagonal of a square, and everything seems to work out. But we're not going to discuss that. We're going to talk about basic fib and Elliott, and the reason why is because it's the foundation of technical analysis. You see, if you look at the bottom here, there was a book, and I'll actually give the book, I'll grab it towards the end, and I'll put it inside the room, if I can grab it from my Dropbox. It's called The Dow Theory. And that book basically says, and it gives you the theory of the technical analysis of the markets, it says that the market can retrace 1/3 to 2/3 of its gain or loss, many times stopping at 50%. So we're going to look at 1/3, 50% or half, and then 2/3. If we translate that to today's math, basically the Dow theory that was put together nearly 100 years ago, if we look at that coming forward, and the basic what we have on our retracements on our computers with the modern day charting platforms, 38, 50, 618, and again, we're not going to worry about all these other relationships. We're going to talk about that in the future when we start getting into the harmonic patterns. All right. Also, we have another webinar, a corporate webinar at 4 o'clock. So I'm going to stop this at around 3:50 p.m. Eastern, and then we'll just take a little break, and then we'll come into the other webinar, which you should check. You should have gotten in your email box multiple times. So please look into that. We're going to start that at 4 o'clock. So when the market goes from low to high, we have what's called a retracement, or if it goes from high to low, we get a retracement. And the retracements many times are 38, 50, or 618, depending if it just started at the bottom. If the market's just taken off the bottom, a lot of times it'll come down 50% to 618% before expanding higher. And then it would retrace again, and if it's a very strong trend, it should retrace no more than 38%, max 50% of that swing that it just went up. So this is called the retracement level, and this is going to play part of what we're looking at in terms of the Elliott wave. Traders tend to look at this right here, the retracement. We look at that. Okay, we look at where the opportunity is on a retracement in a trend of where we can enter, so the trend can continue either up or down. So it's our job to look at these little squiggly lines and try to figure out where we can enter in with the least amount of risk. Now, in a bull market, an Elliott wave is typically made up of 5 waves. Now, in a very strong market, which a lot of times they don't speak about when you're looking on the internet and you're doing your searches on YouTube, or you take classes from other people, they don't talk about the 7th or 9th wave, where many times in a very strongly trending market, and I mean a market that goes up or goes down, as it shows here, reverse is true in a bear market, meaning that trend does this. That many times, if you do have an exceeding of that 5th wave and it continues strong, you'll tend to get a 7th and a 9th wave, and this is what it would look like. But most times, this is what you're working with, and this is what we're going to discuss, is the Elliott five-wave pattern, where the 1 and 3 and 5 are impulsive, going up, and the 2 and 4 are corrective, and even at 6. They're corrective, meaning going down. Now, this is an uptrending market, and the reverse is true in a downtrending market where those corrections go up. Okay, this looks confusing. Let's break it out and let's take a look at really what we're looking at here. In a five-wave market, you have 0 to 1, 2, 3, 4, 5. Okay, you see that pattern. After you have your fifth wave, typically you'll get an A, B, C corrective wave in that. Now, each segment of a trend, this is a big primary trend, this is the big trend up. Each segment from 0 to 1, from 2 to 3, and from 4 to 5, you will have its own little series or mini swings and have its own five wave. The 1, the 3, and the 5 are impulsive. And once you get that first swing up, you then tend to get that ABC corrective wave, which actually becomes that 1 to 2. When they continue up in a trend and you get that second series of the 5 wave, and then you get that one more time, that A to B ABC corrective wave, well, let's think about this. Remember what we talked about earlier was we have this. We have the A to B, C to D relationship like we talked about last week. Essentially, the 1 to 2 and the 3 to 4 are that A to B, C to D relationship. The same as in every little swing on the minor trend, you'll have that. So during the first large swing up that you have, let's just say the market opens and runs up for the first hour, within that first hour, you're going to have minor swings, minor dips, minor pullbacks into this first hour of the day, and then start to go with that corrective wave process over the lunchtime period. So whether we're looking at this as during the day, maybe one whole day, maybe this, or 1 week, or however long on the bigger time frame, each of those swings have minor series in them of swings. This again was put forth in the Dow theory at the time, and then Elliott came in and decided to put his math around it. Okay, good. Now, wave 1, 3, and 5 are impulse waves made up of 5 waves in the direction of the primary trend. All right, you know what? It's hard for me to see that, so let me go back to the felt tip. All right, which means that's what we have here. 1, 3, and 5 are made up of 5 waves, and here are the 5 waves that we just discussed. Now, waves 4, 2 and 4, 2 and 4 are corrections to the main trend, and they're made up of 3 waves or 5 waves. So here, right here, you see this ABC corrective wave. That's 3 waves. 1, 2, 3, where the upside was 1, 2, 3, 4, 5. So waves 2 and 4, which means this one and this one, or the smaller ones, they're made up of 3 waves or 5 waves. Now, what do I mean by a 5 wave in a correction? Well, if we take a look at the bigger picture, the market has these bigger picture moves. When it stops going up and we have the 5th wave of the 5th wave, meaning that this 1, 2, 3, 4, 5 is completing at the same time of the larger term 5, you start to get the correction down, a much deeper correction. Well, in a much deeper correction, you're expecting a large ABC down, but within that structure, it turns bearish for the period of time where it corrects. So you have that 1, 2, 3, 4, 5, then an A, B, C up, and then 1, 2, 3, 4, 5 down to complete the larger term ABC. So when the market finishes going up and it's completed its fifth wave going up, and also the shorter term has completed its fifth, and essentially it's completed one cycle straight up from low to high, that first larger term wave, then the larger term pullback would occur. And within that, you'll have your ABC corrective wave. But since it's a big, longer process, you may have that series of 1, 2, 3, 4, 5, A, B, C up, and then 1, 2, 3, 4, 5 to correct, to get that ABC corrective wave process before the market can start turning up again. So that's essentially what that is saying. Now, impulse wave determine the trend and contain a minimum of 5 waves. Well, basically, this is determining the trend. The trend is up, so that's what it's basically telling you. Now, corrective waves, as we just saw, contain 3 waves. A lot of times, you'll get that 1, 2, 3, 4, 5, and when it corrects, it'll come down sharply and then continue up again, like that. So sometimes you'll have a flush rather than a pretty corrective wave, and that's not out of the ordinary. Now, wave 2 to 3 is typically the largest wave, the strongest wave from here to here in an Elliott wave. And also, it typically will hold 38% of the swing from 2 to 3, and we're going to discuss that in a future slide. And it will hold above this prior number 1 point. So those are the key elements that we want to see in an Elliott wave structure. That wave 2 to 3 is the strongest. On the retracements, it's shallow and stays above that prior number 1 high. Okay, now remember what we talked about in a prior class where we had the A to B, C to D, okay? Essentially 1 to 2, and 3 to 4 are typically similar. So if this is 10 points or 20 points, let's just say 20 points down, this many times will be around 20 points also, give or take. All right. So they'll all be in similar degree of length depending on the trend. A much larger trend will have a much larger wave, and many times it'll be a percentage based, but we're just going to right now for basic purposes that A to B, C to D typically will emulate one another. They'll have that same type of length. And when you see that same type of length, it's something to look at for a trade opportunity or where you could see a turning point in the market. Now, the Elliott wave structure and Fibonacci retracements are important. All right, Elliott wave from 0 to 1 to 2. So we go from 0 to 1 to 2. Now, right off of this area, this many times is 50 to 6, 1, well, okay, I'll tell you what, let me just redo that. All right, it's 50% to 61.8%. Little fee, remember? So off the market lows, it may come down that deep. It may even try to come down a little bit deeper. And that's where you look in for that first higher low. So if you're in the live trading room, a lot of times you'll see me saying, let's look for that higher low to occur. Once we get that higher low, then we can start that process of a trend in another direction. And then the next pull back down, we're looking for that second higher low. All right. So in this example, we look at retracements of 50 to 618 off that first low. When a trend starts to develop from 2 to 3, that becomes the strongest wave. And typically you'll have around a 38% retracement zone and maximum 50% on a retracement. And that's where we start to get that 3 to 4, also known as that A to B, C to D relationship. So this is the structure of that Elliott wave. And then once they have the 5 wave put in, then we'll start looking at that larger corrective process after that. All right, so we're getting our foundations in, and we're going to look at some live charts right now, actually. And we'll take a look at what we just learned. We learned that, and this is a daily chart of the S&P futures. And this looks like it's from December, looks like last year coming into this year. All right, so I was pulling some stuff down and just making some notes. So if we have the 0, and then we have that initial rally, that's that 1. And then the first pullback, as we said, in Elliott, many times 50 to 618. So the market did its first dip and then started its journey much higher. Now you did have an interruption right here, and we could look at that as maybe a minor wave within the continuation of the much larger trend up. And then finally the market got its 3 to 4 wave. And this right here and this were literally almost the same exact amount of retracement. So that would qualify it as a 3 to 4 or an A to B, C to D. The other thing that qualifies it as a good Elliott pattern is it's 38% retracement or less, and that's coming from 2 to 3. And also it stayed above the number 1. So that's a bullish sign on a retracement like that. Now that next drive up put in that 5th wave, and then after that you had that much deeper move down, that A, B, C corrective wave. And within there you had the little minor waves. Okay, you can't really see them here because of much larger time frame bars. And then the process continued up. This right here is pretty much a perfect Elliott wave pattern if you think about it. It really is, because the structure is right there. Here's another example. So you had your 0 to 1 However, you didn't get too deep of a retracement. That's indicating a very, very, very strong market that when you first leg up off a low, it has a shallow move. That's extremely strong. That's a telling sign. All right. So your 1 to 2 had a very shallow retracement, but it was 20. Let me just fix that. Okay. It was 20 and a quarter points down. The next relationship, when it went from 2 to 3, had its correction down to 4, and that had a 20-point relationship. All right, I have a program that plots all the swings, and it was pointing them out, so I thought to share it with you. And then on that fifth wave up, then it gave you that ABC corrective wave, as you see. So we're basically looking at defining the Elliott wave process, the waves, so you know what to look at going forward. So if I say we have a trend and we have an A to B, C to D relationship, or we have a 3 to 4 wave, or there's 4 waves coming down and it can shoot up for a fifth wave, you know what we're looking at. Or if during the course of a trading session, the market has taken off and we say, okay, we're looking at that price relationship that we had on wave 1 to 2, or that first pullback, you know what we're looking at. Okay? And then if we say we're looking for that corrective wave process, you know what we're looking at. All right? We have a good turnout today, actually. All right, so here's what I want to do. You take a look at this chart. Let me clean all this up here. Erase all the ink on the slide. All right, so if I take this, and I'm going to zoom in, okay, because we talked about these corrective wave processes within the structure of a trend, right? We talked about that, but the higher time frame has its retracement like that. But if we delve deeper into it, we could see what happened. So the market made its first wave up and then gave that corrective process, that A, B, C corrective process down before taking off higher. Same thing happened after that third wave was put in. We have that A, B, C corrective process before the market went higher. And that prices, as we mentioned earlier, basically emulated each other. When prices meet, when you have a relationship from here to here, it's really important. The market likes to relate in degree, meaning that if this is a smaller time frame, you'll have little waves in here. A much larger time frame would have much larger waves, and they'll have relationships on much higher levels, as you see on this chart. So basically, what we're looking at is this chart right here, zoomed in, and we could see that within that process, you have those corrective waves, and it's just a natural thing to happen. And I don't care if you're charting sugar, you're charting the S&P 500, you're charting Forex, or you're charting Bitcoin. All right, and Bitcoin got charts. Patterns are patterns of patterns. You can chart the flow of water, the sun, the temperature, and you'll see that chart patterns occur in anything. I don't care what you're doing. It occurs in everything. And it's just for our job to identify this. Okay? Now, going forward into next week, all right, going forward into next week, we're going to have, we're going to discuss a little bit in terms of Fibonacci time, because right now, if we look at the low to high, and then we have a retracement, we know that, okay, 38 to 50% retracement, 618, but what about time? See, time is where you separate everything. All right, today the market was completely sideways, and we didn't want to get in trouble. Yesterday we caught a trade in the futures, a scalp in the futures, and the market did something like this. And we were in the live trading room, and we were plotting out time. All right, we were plotting out time, where time should come in. And when time came right into our zone, those of you that remember, I know Trish was in there, and I think Sean, I see a couple of you, maybe Justin or MB, I see a few of you that were in there. When it comes into time, you have a much greater opportunity of having success than failure, because you know that the market's corrected in time. So what we look at is, for instance, let's just say the market went up for 100 minutes. Okay, let's just say it went up for 100 minutes, and we look at the corrective process. We would say, okay, maybe 38 minutes to 50 minutes it's going to take to correct from here to here. And when it does that, if it's around a retracement level, a horizontal retracement level, it's now exhausted its time retracement and price retracement, and we look for an opportunity for a trade. So the real trick in Fibonacci is not only price retracements, it's also looking at time. Okay, so we could look at all the pretty retracements here. That's great. But the trick is when the markets came up a certain point and we know what the correction of time should be, or at least the zone of where it should be. It doesn't matter if we're entering here, here, or here. We look at zones where to enter and support of where the market should stop going down. And of course, nothing is perfect. Everything's an estimate. But we look at time and price and where to enter into a trade. Okay. So let me just, so in this case, for instance, the market went here to here. If we were to take an exact replica of time, you will see that this time and this time pretty much matched up. A lot of times you'll get from the swings 100% of time should match up. Now let's just say this was 12 bars, okay, hypothetically 12 bars, and this went 12 bars and it was here and it was still correcting, and then it went 20 bars. Well, we have other things that we're going to discuss going forward in terms of what we call overbalancing of time or overbalancing of price, meaning that if price went down to 25 points rather than 20 points and went further than it should. All right, there was a gentleman, his name is Gann. He basically said if time or price takes too long, that's indication that the possibly we can have a trend change. But sticking with the thought, if this had 12 bars, we're looking at roughly 12 bars also. The other thing we look at is we take this low to this high and we measure time. So whatever time it took to go from here to here, from 2 to 3 wave, we're then going to measure 38, 50, or 618% of this. So let me continue of where we were. So when we look at the markets, all right, I know you're going to have to look at this once I record it and I'll put it up on the site. You're going to have to look at this over again, because if it's a little bit too fast, you have questions, you just stop and look at it again. And I'm sure next week we're going to have a ton of questions. So when the market goes from 0 to 1, certain amount of time was spent, and then we look at a percentage just like we look at Fibonacci going forward. The same thing, we look at from 0 to 3. We look at 1 to 3. How long did it take to go from 1 here and a percentage going forward? How long did it take to go from 2 to 3 and a percentage going forward? And how long did it take from 0 to 3 and a percentage going forward? So what it says here is when time zones match, what that means is when we start plotting time, okay, you're going to see they're going to get a cluster from all these different points to the market high. You'll start getting clusters, and when they start clustering up also, that gives you a better indication, because sometimes on a bigger trend time frame you need to do that. You'll start getting clusters of time along with clusters of price, and that's where we try to identify trend turns. All right, and next is next week. All right, we are going to review Elliott wave. We're going to review Fibonacci price ratios like we talked about today. We're going to expand on that because it's going to be important to what we're going to go through. We're also going to go into more of price and time, meaning that price sideways, time vertical, and how they meet. We're going to get into that in detail. I just gave you a little taste of what we're going to look at. Now, what's important is we're going to go into the intro of market harmonics, or what they call market geometry patterns. It's the same thing. You could hear clusters, market symmetry, commonality zones, harmonics, geometry patterns, however you want to call it. It all works out to the same. And I can give you an example in a moment. All right, so if I take the bat, the butterfly, the Gartley, the crab, the shark, the cipher, these are all what they call harmonic patterns that were developed by a couple of people. You have Bryce Gilmore. Originally started with H.M. Gartley in a book he had, and in that book it was page 222. So they called that the Gartley pattern because he figured that if the market did something like this, it had a pattern. So somebody took that, created a pattern, and Bryce Gilmore, who's retired now, was one of the pioneers. Him and Larry Presavento, Scott Carney, and they've put together these books. These you see them all over YouTube, but I'm going to put it all together for you. So don't worry about that. Don't let the word scare you. And then we're going to look at Fibonacci projections, extensions, retracements. We're going to look at three drive patterns. What is that? Well, if we look at a three drive pattern, essentially looks like the five wave. Okay? The five wave is here, but the three drives pattern actually is a climactic pattern to end the trend. And what I'm going to do is I'm going to go back here. All right. So if we look at the three drives pattern, at the end of a bigger time frame wave, we get these three drives. In this last thrust up, you'll tend to get three drives. The market does something like this. Real shallow drives up, and that typically ends the trend. So a lot of times you'll see that on the fifth wave of the fifth wave. So like we show here, you have the fifth wave on the first one, fifth wave on the third leg, fifth wave on the fifth. A lot of times you'll get that, and you'll start that larger term corrective process. The Gartley pattern, as we were discussing, you can have something similar to where you have an X here, and it'll look something like this, okay? Butterflies, Gartleys, crabs, something like this, where basically you're looking at this as A to B, C to D, which is it's another way of saying that the market put a high and then you have an ABC corrective wave. So in a bullish trend, you'll tend to get that pretty harmonic pattern, but it's within the context of a trend anyway. And we look at different levels and spots where we start identifying clusters and both time and price. So we're going to get deep into this as we go into the further weeks. You're going to really like what I have in store for you. And every week we're just going to eat a little bit. We're coming into about 3:47 to 3:50 p.m. And what we're going to do is we're going to take a break. And then we're going to go and do the other webinar. And that will happen in about 10 minutes. So I'm going to take about 15 minutes. So let's take a little break. Let's stretch out. And let me go back to the other chart if I can do this. Hold on a second. Okay. Alrighty. Alright, let's go back here. And as I said, next week we're going to get into all these different thoughts and ideas. And if I don't get to complete it next week, we're going to go for the week after and the week after. And we're going to keep building upon this until you have yourself a nice methodology that you can go into the market and you can create profits on your own. The vision for iMarkets Live, is for learning and earning. All right, you have your signals, that's fine. But those of you that want to learn, that want to pay yourself for a lifetime, that if you want to wake up one morning and take a trip to Indonesia or take a trip to New York City or travel or sit on the beach. I know there's one of our members, Mark Stokes, he's in California snapping pictures every day from the beach, showing his little trading setup. And we have other people that are doing that. and they're sending me their pictures. That's exciting, knowing that you could be successful from any place in the planet. You could build your network marketing business, but you also could have your trading business, and you can create a profit on your own if you choose to. If your hunger is big enough, if your conviction is big enough for success, for understanding the markets. And the other thing is, the fact is, you want to learn this stuff, because when you're expressing this to somebody else, that you educate people in the markets, that we're an educational company and we help people learn and earn, and they ask you, what's an Elliott wave? And you go, I don't know. Well, what kind of educator are you? So you have to ask yourself, you want to be well prepared, and my job is to prepare you well so you have all the information necessary. And just a little bit every day, a little bit every week, guess what? You know more than 99% of the people that will ever walk into the markets, and you can educate them. So you not only educate yourself, and you're able to create yourself your own long-term lifestyle. I've done it myself. I could live literally anywhere on the planet without IML, without anything, just trading alone. You understand? I've been doing that forever. All right. I want you to do that. The other thing is, I want you to be able to educate other people when they come into the markets and they're excited and they, you know, talking about Forex, talking about futures and learning and trading. Sure. You know, the last thing you want to do is say, well, I'm just on the signal. No, educate them. But that's up to you. It's your business, your own independent business. But the dream and the vision of when we started this was educating people to educate people, and teaching people to have their own independent lifestyle, multiple streams of income. You have the network marketing income, you have your trading income, you can have your signals income. All right, we got other great things to come. I'm going to be talking in the next 10 minutes on the corporate call, and check your email. I got some stuff we're going to talk about going forward. We're just getting started, and get excited. I will see you back here next week. I'll put the emails out in terms of the trading education, but we'll go through this next week. I got some good stuff to include, and we'll keep building on it. Once this video is uploaded, I will shoot it out to everybody tonight in a link that it's been uploaded in your back office, and you can take the time to look over it among your leisure. Have a great day, and thank you so much for being part of this.